Hey, it's Mike. I am not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, we're talking about the last week's XDTE payment. We're talking about my margin status as well as the put position that I placed on Monday, how to do, what did I close out of the position? And finally, I'm going to respond to some YouTube commenters. I've already responded in the comments, but I'm actually going to talk about it in person. All right, without further ado, let's go to our portfolio. Portfolio value, $225,477.81. As you can see, we're up 1.27%. And overnight, we're up 0.38%. Last week, we're up or down 3.71%. Last month, we're looking at a minus 5.77%. And the last 3 months, we are down 5.43%. So predominantly on this channel, what I like to do is I like to have a good set of foundational holdings, and what I do is I like to borrow against that money. Your set of foundational holdings could be something like the S&P 500. You can invest in Microsoft, Costco, Visa, really high quality companies, and what you do is you borrow against them. So what I like to predominantly borrow into are income generating assets. I don't like to borrow money and put it into growth holdings because I like getting paid every single week. That is one of the reasons why I am investing in income investments with the borrowed money. And by the end of this, I borrowed, my initial portfolio value was like $300,000, borrowed $300,000. And over the next couple of years, the income funds will pay down that margin and I'll have a $300,000 position that I did not have to use a single dollar for, which would be fantastic. And I'm just kind of showcasing that journey as well as the other plays that I do in this portfolio. But as you can see here, my portfolio isn't crazily down like any significant amount of value. So yeah, let's kind of just go through all our different metrics that we like to track here. So the thing that I did on Monday is I sold a put, or actually I bought a put against a Tesla position, and I'm going to tell you my reasoning behind this. So let's go to our history here and let's talk about it. So on Monday, February 19th, I bought 7 contracts at $55.15, which cost me $38,605. And what my thought process is if Tesla keeps dropping, I need to hedge my position. I'm so far in with Tesla. I have a high concentrated position Tesla that if this does drop drastically, then the XDTE won't have enough time to pay me every single week to pay down the margin. So what I was thinking, as a hedge to protect my overall position, I did some puts against Tesla. Now, some of you will say like, hey, Mike, you're a bull on Tesla, but why are you selling puts? That's a great question. I believe that in the short term, Tesla, nothing on its balance sheet is going to move until after the next 6 months, 8 months, 12 months. And I think 2025 is really a wash for Tesla in terms of like seeing anything fundamentally change on the balance sheets. However, all the plays that they're doing to accelerate their growth are in the process, and we won't start seeing that on the balance sheet until 2026. So my thought process was I want to buy my XDTE position a little bit more time to keep paying me that $1,000 a week to keep chipping away at that margin. So what I did, I sold those 7 puts. I bought the puts and I closed out already, but then I tacked on another put position. So we'll talk about that. So over here, buy Tesla 330 put, 12.19. You can see here it got filled. You get the regulatory fees, and this is how much it costs. It costs $38,000. And then because Tesla dropped a substantial amount, the next day or so. So I actually closed this position out. So these are my 2 sells of that put. So 12.19, or actually that same day, sorry about that. The following day, I closed out the position and I paid $38,000 for it. And if you add these together, it comes out to $48,685, which nets me a $10,000 win. So got a $10,000 check. And just because I was hedging my position, and then I closed it out and I was happy. I made my $10,000, but then I thought about a little bit further. So if you look at Tesla, let's look at the chart. Let's talk about some technical wizardry here. Now, I'm not a huge guy of technical analysis, and I don't think you should be basing any of your investment decisions truly on technical analysis. However, I think that we should look at the chart. And I'm just really going to show this chart really to illustrate a point, not necessarily talking about like technical analysis and 200-day moving averages and things like that. What I want to show you is, let's look at the last year to date. So last year to date, Tesla's been trending down, and it's down 24%. Let's look at the last year. So in the last year, our lowest point Tesla was $142 share, and the highest point was, let's see here, $479.86. Now, ultimately, this if we look kind of closer to this area, this is the area where Elon Musk really started endorsing Donald Trump, and there was a lot of hype and the animal spirits were going in. Nothing fundamentally changed about Tesla when Elon Musk was hyping Trump, and which is what's causing this stock to skyrocket. Yeah, they're talking about, full self-driving, perhaps the cheaper Model 2 coming out, but fundamentally the company metrics did not change. They didn't have any blowout earnings that would justify such a gain. Their profit margin didn't justify to have from almost a $200 to $400 share price. Ultimately, I truly believe that the actual place that Tesla should be trading is right about this area. So 180 to this 269. So if we're truly thinking about it from here to here, there's a lot of chop in between here that Tesla isn't above where we're at now. So right now we're at $292 a share. There's still room for Tesla to keep going down. And what I want to do is I want to protect myself from that drop. So what I did is I sold more puts. So if we go back to our history here, instead of 7 contracts that I bought, I bought 14 contracts. So I bought 14 contracts here for, let's see here, not sell, buy right here. So I bought the exact same 12/19 expiration date on February 26th. I bought 14 contracts and the total cost is $82,460. Now this isn't cash that's sitting in my account. I had to use margin to do that. And what I was thinking is if the Tesla price does drop, this is going to hedge me from getting a margin call, because for every single dollar goes down, I'm going to keep getting money for the share price going down, and this put position will pay for that difference, if that makes sense. And it'll make a little bit more sense when I pull up my margin thing. But I'm selling 82. I bought the 82,460. I paid that much money. I had to use margin for that. But it is a huge hedge for us to ride out the next 12 months and truly, wait out this period of time where Tesla could perhaps drop. Going back to that Tesla chart. So again, like I said, this has been last year. So this is where we've truly been trading without any fundamental changes. So the lowest point, 147, highest point, 260. So I'm hedging myself for Tesla to drop a little bit further. There's really no, there might be one more drop here before it hits this 217. So for me, I'm selling these 14 positions. I'm going to close out 9 of those positions when it kind of gets closer to this 216 mark. And then I'm going to just let the 5 ride out, because if I close out, if Tesla does drop down to 216, I'm going to close out this $82,000 position with at least a $10,000 gain. And then the other 5 options that I bought, those I will ride out till truly the end, because I already had them paid for. That margin position is paid off, plus a $10,000 plus. I'm going to just let those ride out, just really to protect my positions. So that's kind of what my put strategy was when I bought it on Monday. Again, both super bullish on Tesla long term, but we need to ride out these next couple months just for that XDTE to keep chipping away that margin to reduce our risk. Okay, so let's go back to the main page and let's just kind of go through every single position. So I did say that I'm going to close out these put positions. So these are just the pending orders. So I'm going to be selling 9 of them at the 103.45 limit order, and these are good till canceled. And with these, like I said, I should close out about a total of $103,000, $82,000 worth of the actual cost that I paid for it. So whatever that difference is, it's going to be put into my account. And then again, I'm going to let those 5 positions that I bought ride out. Continue going on. Let's just kind of go over the Tesla stock that I own. I own 900 shares of Tesla. You can see my market value, $264,000. We're still up, even though Tesla's been on a pretty drastic decline. We're still up a good amount of money. You can see here my average price paid. My actual price paid was a lot lower. It's closer to $181 a share. But after switching brokerages multiple times between Fidelity, M1 Finance, Robinhood, the cost basis got lost, and we're just going to continue with that. As you can see here, I have my 2 strategies. I have my put strategy, my call strategy. And actually, I do want to talk about my call strategy, but we'll talk about that after I'm done with this. You can see here margin requirements 30%, and we're just hanging on to it. So I'm not going to necessarily talk about the next, catalyst for Tesla of what's going to go forward. They're in the process of, expanding their capacity, and there's no reason to be going through the details right now. I wanted this to be more of an XDTE video, get the payments in, talk about that put option strategy to protect my portfolio, and to move on with my life. All right, so that was the Tesla position. And so let's just talk about the calls here. So I'm actually in a position where I could roll my calls down. You know, when you're doing a covered call strategy, you're assuming that the stock is going to be bullish and that you're going to capture that premium upside. However, I don't know if you guys remember my previous videos, many videos ago, that I blew past my 450 calls and I had to keep pushing my option further and further out. Now we're at a time where we could roll our options. So let's just look at the options for our options. No pun intended. So let's roll this position. So I do have 9 covered calls here, and like this is the expiration date. So this is the latest you can have, it's just June. Mine are actually in, here, let's show it. Mine are actually this January 15th. So I have a whole bunch here at 9. So this is where we're at. I can roll this position a little bit closer and closer to at the money. And so instead of waiting the 684 days to wait for this position to expire, there's a couple of options I can do. I could push a little further to wait longer, or I can make it closer to our date. So remember, I was looking at the June 20th here. And if I truly think that in the short term, Tesla's going to go down and I have full conviction is in it, then there's a couple things we can do. A lot of people have been burned trying to guess what Tesla does. You want to position yourself in both positions. So current price of Tesla is $294.26. So what I can do is I can buy back my $6,100 position, and I can buy some of these at a loss, knowing that I just reduced the amount of time, and that if this Tesla does hit this price, or if it's below it, then I can go ahead and roll that option to further date to keep acquiring premium to make up for that $2,000 loss. Or I can get paid a credit, but I would have to assume that Tesla's going to go down a little bit further. So $6,113 is what it would take to close out this position, and $6,113 is what it would take to close my position. If I set this here, so $6,188, because remember, one contract is 100 shares, so that's how much it would cost, $6,188. This is the credit I would get. So if I wanted to roll the position, I would have to buy this back and then I would sell this. However, I would have Tesla dropping till 255. Is that worth that risk? And then having to sell at a price you didn't want to sell it at? There's always that risk. But as of right now, I'm already protecting myself with the put position. So I don't think I need to get some more gain. However, I was thinking about this. If I truly did think, like, we could look at the technicals again. If Tesla did drop down to say $200 a share, and I'm adamant that Tesla's dropping $200 a share, and it'll get down to $200 a share by June, I can get paid $10,355 for that position. So it'll be a difference of $4,000 per contract times 9 contracts. That's a good chunk of money. So, you have a little bit of options here, but, I'm not the type of guy that would want to roll out knowing that a stock is going to go down. Like, I would rather just open that put position. However, if you truly knew that Tesla was going to get down to $200 by June, you would do this and you'd be cashing in almost $10,000 per contract. So we'd have almost $90,000, close for 60. You're up $30,000. That's a lot of money to be up. So these are the things, though, like you can set any of these option positions any way to hedge your portfolio or put you in a position to succeed. But you have to decide like what that company is going to do. If you're picking single stock, if you really understand how that company operates, how it trades, then it's much easier versus like, say you just strictly just focus on the S&P 500 and any given company can move the market up or down. So there's that. I could roll this down. And if it does roll down to this position, like, it'll be good. So I'm still thinking about it. I haven't decided what I'm going to be doing to roll this position. I'm going to see what's in store for tomorrow and Monday. And then finally, let's talk about the XDTE, and then we'll talk about like margin maintenance, all that other fun stuff that I like to talk about. So XDTE, this is the covered call fund that I do that pays me weekly, has a 25% margin requirement. Let's talk about your market value. So overall, my price performance on the XDTE is $273,000. It was initially a $300,000 position, so we truly are down $26,000. However, because it pays us, it takes the growth and transition it to income, we get paid in income. So necessarily like what this company, or excuse me, not this company, this ETF does in a week, you have to add on the income that is paid out to it. So for example, the XDTE is down 1.94%. Let's compare that to the S&P 500. So 1.94, and S&P 500 is up 0.39%. So XDTE is taking a bit more of a loss than the actual S&P 500. But at the end of the day, you know, our focus here is income. If I had this money sit around and I didn't touch this for 6 years and I get my $1,000 a week, this is paid off in, what was that, 6 years? 6 years this is paid off, $50,000 a year, 6 years. I have an entire $300,000 position that was paid off, and then every single week I get $1,000. Like, that is enough money that if you had a paid off mortgage, paid off car payments, you should be able to live in this country. But I digress. That's a side note. But again, just overall, like, price performance, we're down. Like, there's nothing to say more about this. We're down. And one of the comments that I'm going to respond to is going to address the differences, and I'll kind of read through what my response was. And these are key metrics. And then finally, let's talk about the distribution. So after all of that about my portfolio, we care about what we're getting paid every single week. So because I own the 5,641 shares, we got 20 cents a share, which paid out $1,146.51. Pretty good amount of money. Again, $1,000 a week, 52 weeks, that's $52,000 a year. I think that is great. And then let's just go to like this investing profile here. So you can see my equity position, $225,000, and then the margin used. So it was $266,000 after I closed that put position on Monday. It was 276. It was 276. Then closed out a position was 266. But because I opened up that $82,000 put position, I bought that put. My margin did go up. However, let's talk about the margin maintenance. You can see here. So my margin maintenance is $182,000. If my position drops down to $182,000, that means my put positions will be printing. If my account truly goes down to $182,000, those put positions that I have open are going to be winning me a lot of money. I'm going to close those out. That $82,000 I borrowed is gone, plus the gain, because if my account truly is at $182,000 because of put on Tesla, because I'm really concentrated in Tesla, we're going to be printing money. And that is going to be awesome if that does happen. Now, say that does not happen, and say Tesla decides, hey, you know what? We're still going to be trading irrationally for the next year, and it moves parabolically up again. That's a win for me too, because to close out that position plus my Tesla gain, that's a win. So whether Tesla goes up or Tesla goes down, I've figured out a way to be in a winning position. And again, I'm more than happy to listen to some comments just explaining like if you really think that is the case. But if, again, my portfolio goes down to $182,000, my puts are going to print, right? Just kind of like a side note, but yeah. So I did increase my margin amount because when you purchase options, it's not a 25% margin requirement. It's not 30%, it's 100%. So the $82,000 got applied onto here. So I'm assuming that the $82,000 was added on and the $100,000 is just what my portfolio is doing because it was going down. And then you can see here, outstanding interest is adding up every single day. And I think it comes out to $50.45 every single day. Let's move on to just the XDTE performance, and then we'll move on to the comments. You know, we just got paid this February 28th, $1,146. As you can see here on the 14th, you know, we got charged that $1,200. Again, that's the cost of doing business. And as you can see here, I just pretty much copy and pasted the market value from the Robinhood onto here, my $300,000 position. So yes, we are down to $26,000. But if you count for the total income, subtracted for that, it's much less. However, I do subtract the margin interest as well as the Robinhood Gold from that total income. So really, if you tack on the $17,000 to this, our actual loss is about $9,694.11, which comes out to 3%. Again, 3% loss is not that bad. However, the entire market's been going down, and usually with these funds, it takes a little bit more time to recover because whenever there's a distribution, the stock price, the share price goes down by the amount it distributes. So for example, if the S&P 500 is flat, but there's a distribution, the covered call fund will always be less. However, if you do reinvest it to some degree, you know, your income will grow over time. However, I would rather get this margin paid off first and then take the money, reinvest, buy other stocks and things like that. Like, I want this to be the income engine to my portfolio. I'm not putting any of my own money in here, and that's what it's doing. But this, we're kind of at, so since December 20th, opening this position, we are down 3.23%. Not too bad. All right, let's go through the comments now. So we're gonna go to the comments. Let's just kind of run through what people are saying here. By the way, shout out to Project Premium Harvest. That's my bro. Check out his channel. He's doing some great things over there. You know, the puts, he said it was a great idea. We talked about it over the phone. We did it. We cashed in on it. It was a great win for us. So, you know, thanks for keeping me up with it. After your videos, I decided to buy XDTE in small chunks instead of dropping 100 plus 100K. Great. I love that. You know, if you're just starting out, you shouldn't be dropping $300,000 in margin. A lot of you don't truly know my story, or maybe if you actually did watch my earlier videos, like I use margin to actually sell covered calls on Tesla, and we made a good amount of money, and that's one of the reasons why I have so many shares of Tesla, because I profited so much from selling covered calls. I was selling covered calls on Tesla when it was making one of its parabolic moves up in like 2020 or 2022, and that's what predominantly bought most of my positions. And then obviously I was working like all these overtime shifts plus that to buy it. But when you're starting off, you really shouldn't be putting hundreds of thousands of dollars into these covered call funds. You know, if you understand option investing, it's a relatively safe strategy, but at the same time too, the truest way to build wealth is to own companies, like real companies and assets. Like putting your money into like an XDTE, you're not really owning companies. You're just investing in fake money that gets someone pays you insurance for, and you're pretty much paying for insurance. And you know, to some extent, what truly is going to build you wealth is like owning real companies that produce real things and real services. So, you know, to a certain extent, that's why I don't, you know, want to put my own money into these covered call funds. That's why I'm borrowing other people's money to do it. But, you know, if it pays income, I'll take it. And then maybe at some point I'll go back to selling options myself. However, the work that I do, I'm not in a position to be constantly monitoring my trades. And also the amount of like cancer and autism of just constantly focusing on the stock market just really destroys your mental. So just a couple thoughts about that. All right. So passive earnings, by the way, I love your channel as well. Hi, Michael. I love you've been consistently making 1,200, 1,500 a week from your XDTE position. But if I were you, I would not buy naked puts on any stock, let alone Tesla. Your covered call is already a bearish strategy in place. So buy a put in the money, at the money, or out of the money would be, again, a bearish strategy in place. If I want to hold Tesla long term, I would sell cash secured puts that are deep out of the money. So worst case scenario, even the price does get to your strike price, you can roll it back, going more out of the money for longer expiration date. Passive earnings, absolutely agree with you. I actually was doing some sort of wheel strategy before I did this whole XDTE position. And the thing about selling cash secured puts is, you know, you'll be making some pretty good money selling the puts. However, by the time you get assigned those options, you have to own it. So then your stock price, your portfolio value has already decreased, and then now you're going to be opening up a $20,000 position or $40,000 position. Whereas for me, yes, I did open up an $82,000 position, but as the stock goes down, I'm the one that's making the money off of it. Whereas I would have to, you know, cough up the full amount of margin. So like when you're selling cash secured puts, your money is set aside as collateral, and that's still getting pushed on your margin maintenance. And right now, like, yeah, I mean, I could have opened up $82,000 worth of cash secured puts. However, by the end of it, I would have to own $82,000 cash secured puts. And then I don't want my margin maintenance to be over $350,000. Like when these cash secured puts, you know, the ones that I bought actually hit the price that I want, that takes away from my margin maintenance, whereas doing the cash secured puts would add on to my margin maintenance. So in that kind of position, I would rather not sell the cash secured puts, and that's why the puts in this position would be great. You're right. The covered call strategy, it is a bear strategy. So, well, technically, if you want to make income from a covered call strategy, it is a bullish strategy. But if you're thinking, hey man, this stock is going to drop, I want to get some income to offset some of that loss, then that is a bearish strategy. Yes. However, it really depends how you played. I just pretty much I view covered calls as a thing. If especially I own the stock, is a thing that I can optimize a little bit more gain for owning the same underlying. The XDTE is supposed to be the income. So yeah, I could sell the options myself, but I would want to do it for more income. But then more income means like you have a higher chance of your positions being assigned. But that's just my 2 cents on it. However, there's no real correct answer for any of this. But like, you know, I agree. Selling cash secured puts, you'd be making money. You could roll it if it keeps going lower. But I truly think that when Tesla goes down, it goes down fast, and I really want to capture that downside. Yeah, but that's just kind of it. Yeah, boy, keep the XDTE train chugging. That's right. Every single week we're getting those paychecks. You know what? I love getting paid every 2 weeks. Getting paid every single week is another paycheck. I love that. All right, M224.7. All right, why not buy back the covered call and make them closer to expiration to capture the volatility? Say 1 to 5 weeks out where that decays the fastest. Eventually, your cost basis on those shares will be zero, and it'll be a cash machine, or stick the premiums into SPY-based ETFs. Yeah, great question. I am thinking about buying those covered calls, and I think I responded to your comment. I will be buying those back, but I still haven't decided. It's like I said, I have a couple options. If I truly think that Tesla is really going to be going down, then I can sell those 200 covered calls and bank in almost $90,000 worth of premium, and sell that position at $60,000 or whatever. But again, that's still going to put me at the risk of having to being assigned at $200 a share. Yes, I would reduce my time overall because I am selling the January 2027 calls, but I can buy it closer to the money and then turn that around and then just sell every week and move it up. So I have thought about that. So that's a great question. But again, the market overall, the S&P 500 has been looking frothy. I mean, we've been on a bull run for a couple of years now, and I think now's the time where I think fundamentals will slowly start making a little bit more sense than the animal spirits. Right now, we've been truly feeding off animal spirits, and I think that going back to it, I'm kind of waiting out to see what happens this week. If Tesla does keep dropping, I may actually purchase it and then sell. Covered calls on Tesla that have like a 5 and under delta. But hopefully that answers your question. If not, then shoot me another comment and then I'll try answering it in a better way. Let's see here. Great video. I like the idea of putting on the protective puts on Tesla. Once the other thing you must factor in your accounting is the management fees on XDT. Also, you have considered just buying shares of SPY and margin, selling covered calls, generating income as well as capital appreciation. I love XDT as much as you do, but I think it's kind of loses its luster as an income vehicle when it can't beat the VIG. I've been looking at GPICs and SPY as those offer limited income, but also give that capital appreciation. Just some observation I made. Love the channel and appreciate your transparency. Great. Appreciate it, bro. Yeah, you know what? I was selling covered calls or cash secured puts or like the wheel strategy on the S&P 500 itself. Like, yeah, that management feed is, it definitely puts a fork in a lot of things, but I just like the thought that I don't have to manage those positions myself. Like, yeah, that 0.95% management fee, it does suck. However, they probably would put it at deltas that would harvest more premium, whereas like I naturally like the GPICs and SPYI where like it's less income but then you still get that capital appreciation. So at some point I feel that once I do get my XDTE position totally paid out, then I will start building like the S&P 500 position and start doing those myself. And then yeah, I was doing those S&P 500 I was doing like daily cash secured puts or covered calls or like that wheel strategy. And, it was making a good amount of money, but I think you get a little bit more income with these XDTE. And yeah, we are going to lose some capital appreciation, but at the same time too, as long as like we're getting that good amount of income and we do pay off that margin, then it's just another income source. If you look at our incomes, like our actual job incomes over time, like we're losing it to the price of inflation. If you're not getting a job raise more than 5% every single year, you're losing to your price of inflation. So technically your earning potential for your actual W-2 job is going as time goes on, but you still need that income. Like the income can go up, but you're still losing overall if you count it as the NAV value going down. But I want to have an income arm in my portfolio so I can, start dishing cash out to different positions. And the wonderful thing is like, the whole point of this is to not use my own money. Like by the end of this, yeah, like if my $300,000 position is worth $250,000, but I still get $1,000 a week in income and it paid off my margin, it paid me $300,000 worth plus a weekly income. So I think that's a win. But yeah, I do like the GPICs and SPYI. So if I was going to use my own money, like my own hard-earned money, and put it into any covered call fund, it would probably be like GPICs or JEPI because like you are getting that capital appreciation with less income. So if I had $100,000 of my own W-2 money, I probably would put it like in JEPI or GPICs or SPY because you're tracking the S&P 500 and you're getting a little bit of income. Plus, you're getting that appreciation. Whereas these investment vehicles like XDTE and Tesla and the yieldmax, things like that, they are strictly all for income. So there's pros and cons to each one. But like if my own money, GPICs, and yeah. All right, carrying on. Sell your Tesla and put it all into XDTE. Done. dude, if I did that at the high where Tesla was like $400,000, if I had a $400,000 XDTE position plus this $300,000 margin position, I would be printing money every day. I'd quit my job. However, I want to pay off my mortgage first. I want to do some other things, but that would be a win. However, going back to what I said earlier in the video, I think that if you're going to use your own money, it needs to be in real assets. It cannot be in these covered call funds. So yes, invest in the S&P 500, invest in that SCHD, pick your individual stocks. I don't care, but like you need to invest in real stocks with your real money. And then if you want to do these, G picks, all these other things, more so than not, that's where I want to use the borrowed money. But again, like I said, I would use G picks with my own money because you are investing in the underlying and they sell the calls against it. This is a good one here. So I really appreciate this comment because if you're not able to argue your point, then you probably shouldn't be doing any type of strategy. So I really appreciate this awesome sauce 1717. So this is what they wrote. So essentially you lost money due to taxes, NAV erosion, and margin fees. Taxes are particularly unfavorable for your tax bracket, especially assuming you live in California. Based on that, you definitely lost money. This strategy doesn't work. Your video didn't really address whether you owned anything. You only discussed how much you made in dividends, which doesn't show the full price. We don't know if the dividends you earn were your only source of income. If that's the case, then okay, you barely profited from this strategy. However, if you also had a W-2 income, which I recall you mentioned in previous videos, then you definitely didn't profit at all from this. As I said, NAV erosion, taxes, and margin fees would have eaten into your gains. I mean, these are all valid criticism, absolutely. And then this is kind of what I wrote. I will discuss these. Here, I'll tell you what, let me read what I wrote and then we'll kind of discuss that a little bit further. Now, I wouldn't say the strategy doesn't work. It's too early to tell. In all honesty, I picked the wrong covered call funds to start. I had Tesla, and had I had XDT earlier with its lower NAV erosion would be different. That's a side note. Imagine that the next 5 years, XDTE income after taxes and margin expenses pays down the entire margin balance. I don't spend a single dime in reinvesting back into the fund or my own money. I'm ultimately left with a position that pays a minimum $1K a week, even if it costs $300,000 plus margin expenses. Having the weekly income is a nice hedge to reduce portfolio volatility. Now, I may agree with you that this strategy doesn't specifically beat the market. I wholeheartedly been saying that these covered call funds will never beat the market, but the income helps. But let's keep reading what I said. I can agree with that. Any covered call strategy will always fall short. However, the income here is the key. If I asked you for your W-2 job, would you want to be paid in shares or income? You would say, I need the income, please. Can't really off being paid in shares bi-weekly to pay your mortgage and car payments. The growth from the SPY is transferred to income. Yes, you may pay the taxes along the way, but I look forward to those weekly checks. Overall, the performance of XTT in SPY has been pretty comparable in the last month's choppy market. I want the income to be able to spend the money. Another key is that once 300K is paid off, I would not have used a single penny for it. It was all other people's money. So if I never was going to implement borrowing money to buy covered call funds, I would never have built an income stream. Even with the low returns, it's still more returns than doing nothing. Would it have been better to buy a whole bunch of Microsoft stock or Amazon stock with margin, sit on it for many years, then sell at a gain? Sure, you would get more gain. However, the weekly income of XTTE paying down the margin lets me sleep better at night knowing it's slowly chipping away at it and reduces single stock risk. There are some studies that say having a covered call fund strategy does reduce your overall portfolio beta. I'll take lower returns for my income. Ultimately, we shall see. At least this is a fun thought exercise and we get to discuss about it. So that is a wonderful thing about, showing this stuff on the internet is I get to defend it and you can poke holes in my argument and see if it actually sticks. So everything I mentioned, I feel is valid. So yeah, you know what? This is, there's a lot of people that will trash on these income funds. Like these all suck. The gains suck. You're absolutely right. However, if by the end of this, if this does work exactly how I imagine it, and this $300,000 position does get paid off in the 6 years, then what are you going to say then when I get that $1,000 check when the margin is paid off, there's no margin interest, and I do get $1,000? Yeah, maybe I would have gotten my entire return back from the borrowed money, and then now I have a position that pays me $1,000 a week. Like, how is that not a winning formula? Now, yeah, absolutely, you're right. Like, if had I invested more money in Tesla or Microsoft or Amazon, I probably would have had a much higher return. But it's not always about the returns. Doing this margin strategy, I would have not been borrowing money. Like, imagine if I just owned Tesla and I didn't sell any options, didn't sell any calls, didn't do any margin, and I just sold Tesla. I'm not getting more gain with the margin is allowing me to get more gain. Maybe it's not the highest gain, but I'm still getting more gains than doing nothing. So hopefully that, I feel like that would explain, hopefully that explained in a sense kind of what my thought process is behind it. And then, I am doing certain things to hedge my position so that get that margin paid down faster. But, I want this $300,000 position paid down as fast as possible. And having the XDTE that pays every week is great. Like, I don't have to wait till Google to blow up and then I can sell out to pay some of that margin. I know every single week we're just chipping away from that margin. So, hopefully that was like a good comment to respond to, and hopefully you guys enjoy that. Let's just kind of go along here. Oh, and then this was just a comment, so I agree with this gentleman over here. But that is pretty much everything I want to talk about in the video. Hopefully you enjoyed the video as well as understood kind of where I'm coming from with some of these topics and ideas and all that. So hopefully, this motivates you to get investing. If not, you definitely could watch on the sidelines, but definitely please ask questions. I love asking questions. And finally, don't forget to subscribe. We're trying to get a 10,000 followers over here, and 2,777 is not 10,000. So definitely give it a subscribe. And besides that, you all have a good one. Peace.